Hello and welcome to our new tutorial, Option Strategies. Learning Advanced Option Strategies. Let's go through a quick introduction. In previous option tutorial, you learned about options, what is the nature of options, what options comprises of, and what determines options pricing. Like we learned about what is intrinsic value, what is time value, how volatility determines options pricing, and what are the conditions that affect options pricing and the movement. In this tutorial, we will learn about some more advanced terms and learn about various setups that can be formed using options of different strike prices. So without further delay, let's go ahead and get started. Option Greeks. In previous tutorial, we learned about what is intrinsic value and time value. These are factors that determine how much intrinsic value and time value should an option contract hold. The Greeks are the factors that will determine pricing of options. These factors determine the rate of premium decay, and if you have an idea of these factors, then you will be in a better position to manage your options contracts effectively. So it is very necessary to know what is going on with the geeks of an option contract that you are holding. These geeks will help you understand the nature of the movement of options, and they will keep you in a better position, in a well informed position. They will also help you in warning against any potential market change. These factors are known as option geeks, which are divided into four: delta, theta, vega, and rho. Let's go ahead and learn about them. First geek is delta. Delta is the amount an option price is expected to move based on 1 point move in the price of underlying. If you have ever noticed the pricing of an option, the movement of an option price, you will see you might have noticed that options at different strike prices move with a different speed in compared to the underlying contract. For example, if you are observing option of Nifty futures, then you might have noticed that an out of the money call or put option will move lesser, will have lesser movement as compared to the movement in Nifty, whereas an in the money call or put option will have will move one on one with futures movement. This is a very important point to keep in mind, that not all options move one on one with the underlying. So Nifty options, not all Nifty options that at every strike price will move one on one with Nifty futures contract. Some options will move one on one with future contract, but others will move in varying degrees. How much they will move depends on their delta. Many a times we buy a cheap option, we expect it to move one on one with underlying contract, but soon realize that such is not the case. Delta of an option is determined upon the closeness of option strike to underlying price. The closer an option strike is to its underlying contract price, the more delta it will carry. The closer out of the money an option strike is to the underlying contract price, the more delta it will carry. Once the option strike becomes in the money option, then it will have highest delta of 1. The maximum an option move in relation to its underlying contract is 1 is to 1. For every 1 point move in underlying contract, options will move 1 point. So if Nifty future increases 30 points, and in the money call option will increase 30 points. If Nifty future decreases 30 points, and in the money put option will increase 30 points, and an in the money call option will decrease 30 points. So as long as an option is in the money, it will move one on one with underlying contract. If it is out of the money, only then its movement will be affected by its delta, and delta of that call option contract will determine how much that option moves. And the delta is determined by the closeness of the strike price to contract value. So if Nifty future is trading at 8,500, delta of 8,600 call will be higher than delta of 8,700 call. Similarly, delta of 8,400 put will be higher than delta of 8,300 put. So delta always has a range of 0 to 1, which means highest delta is 1, whereas lowest delta is 0. The more out of the money an option is, the lesser delta it will carry, and lesser movement will be seen in option price when compared to price of underlying. Our next option Greek is gamma. Gamma is the rate of change of delta. If an option has low gamma, then it means the rate of change of delta is low, which ultimately affects options pricing. If an option has high gamma, then it means the rate of change of delta is high, which can reflect in volatile options price movement. And at the money, option will have highest gamma rate. So a gamma is the speed of delta. Gamma will determine with what speed a delta will change. Let's say at a particular strike delta is 0.8, and once underlying contract value price comes nearer to the strike price, delta will increase from 0.8 to 1. So now the option will have one on one moment with the underlying contract value. The option experience an increased gamma value of 0.2. So delta increased from 0.8 to 1, which means the gamma increased 0.2. So gamma is basically the speed at which delta will change. If an option has low gamma, then it means the rate of change of delta is low, which ultimately affects options pricing. If an option has high gamma, then it means the rate of change of delta is high, which can reflect in volatile options price movement. Many a times you will have seen that sometimes options are priced higher, and at other start of the expiry month, options are priced extremely lower. Options are priced at cheaper premiums. At other times, options are priced at higher premiums. These options premiums depend on the volatility in that stock, or depends on the volatility in that future contract. And that volatility, the rate of change of that volatility is determined by gamma. So if higher gamma, it will indirectly reflect into higher option premiums, and lower gamma will indirectly reflect into lower options premium. Theta. So the next option Greek is theta. Theta is the value decay an option faces over a period of time. Basically, it is the time decay of value of an option. It is one of the biggest hindrance for an option buyer who is anticipating price movement in favor of his position, but has yet not happened. For an example, 30 days away from expiration, an option is priced at 100, and 5 days away from expiration, underlying value remains unchanged. The price of option will have decreased to rupees 10. This happens because theta was underworked. So theta is basically time decay. Every option carry premium, intrinsic value and time value. Intrinsic value is something different, but time value depends on theta. Theta determines by what rate an option price will decrease every day. You need to have a good understanding of theta if you are an option buyer, because every option will carry a particular rent. So before if you want to buy an option to participate in the underlying movement, you'll have to day a day you have to pay a daily rent for it. And that daily rent, how much will you have to pay to carry the position for one day depends on theta. Theta will determine how much you need to pay every day to carry your position. As I have given the example, 30 days before expiry, if an option contract is priced at 100, the same auction contract will be priced at 10 rupees 5 days before expiry. And that happens because of theta, because there is less time left for expiration of that option contract. So there is less time available for a trader to carry the option contract. Hence it is priced at 10 rupees, which means it has not much time value left in it. So if you are a buyer of option contract or a seller of option contract, you need to understand how much theta, what is the rate of theta, how much will you have to pay, or how much will you get in form of rent if you were to carry a position. Our next important Greek is Vega. Vega is the amount call and put price will change for a corresponding 1 point change in implied volatility of a stock. So this is also an important option Greek that you need to be aware of. But it is quite a bit sophisticated as Vega is calculated on implied volatility and not calculated directly from options price. So Vega is the amount call and put price will change for a corresponding 1 point change in implied volatility of a stock. For example, let's say an implied volatility for a stock is 5. Volatility is 5 and Vega for option stands at 0.05. Now if implied volatility for the stock rises to 6, that is 1 point, then Vega might rise to 0.1, which means the price of option will rise 0.05% when there is increase in implied volatility. Similarly, when implied volatility falls, there could be fall in Vega, which will affect options price negatively. Often we see in markets, whenever there is high volatility in market, options are priced higher and options are priced lower if markets with low volatility. So the pricing of options depends on Vega, that is the rate of change of implied volatility. That concludes our option Greeks. Now let's go ahead and learn about option strategies. But before that, let's do a quick revision. We have option Greeks as delta. Delta is amount an option price is expected to move based on 1 point move in underlying. Then we have gamma. Gamma is the rate of change of delta. Gamma is a derivative of delta. It determines the speed of change of delta, the speed of delta basically. Then we have theta. Theta is time value of an option contract. Theta determines the rate of change of time value. Each day, how much time value will be degraded into an option contract is determined by theta. Then we have Vega. Vega is a derivative of implied volatility. Vega is the rate of change of implied volatility, and Vega will determine how much increase or decrease an option contract value will face with a change in implied volatility. So now let's go ahead and learn about option strategy. Option strategies. There are a number of option strategies to exploit the Greeks that I mentioned above. Some strategies are simple, whereas some involves use of multiple strategies to form a third strategy. Many strategies are complex and require position adjustment. Let's take a look. Our first strategy is long call. It is a simple strategy, involves buying a single call option. Risk profile, limited loss, unlimited profit. Bullish strategy. The strategy will be used when a trader has a bias towards long side on a particular stock, but the stop loss is needed to be kept too far away from the market. In this case, he will calculate his risk profile and simply buy a call option, which limits his loss side. So a long call is basically a very simple strategy. In fact, it is not even a strategy. All you have to do is, if you are bullish about a particular script or contract, you simply calculate the maximum risk you can take, or the maximum you're willing to lose, and then you simply buy a call, taking a look at its strike price. How near is the strike price to underlying contract value? What is its delta? How much theta will you have to pay every day to hold that option contract, and so on. And you simply make all those calculations and buy a call. It's that simple. If you think market is going up, you simply buy a call. After doing this calculation, you need to do these calculations of option gigs, because they will make you aware of how much you will have to pay every day to hold an option contract. Hence, option gigs are important. So a long call is a very simple strategy. In fact, if you are bearish about a particular contract, for let's say you think for the given month Nifty futures will fall throughout the month, or if there is a certain kind of resistance which you think is very important psychologically, and prices will definitely fall, but you're not 100% sure, chances are prices might not fall and they might simply explode after breaking out the resistance. So in order to limit your loss, you will simply go ahead and buy a put. If you are bearish, you buy a put. You create long put. If you're bullish, you create a long call setup. So these are simple strategies. This was the main reason why call and put options were developed, so that you could have maximum profit and limited losses. This is how long call risk profile looks like. Increase in underlying value is this way. From going from left to right is the increase in price of the underlying value. If underlying value price increases, you can see here the call, this is the maximum loss you will face if you buy a call. And once underlying value reaches a threshold, after that call price starts increasing, and there comes a break-even point where you are making no profit, no loss. And after that break-even point, if underlying value sees any kind of increase, you will make profit on your call option. If from this break-even point underlying value was to fall towards zero, your call option will start making a loss, and it will make loss only until this point. Once your underlying value reaches this maximum point, your call value becomes negligible or zero. From there point on, if underlying value was to go down all the way till zero, you will not make any loss. Your loss gets limited. So if you're buying a call, your loss is limited to the premium you pay, whereas your profit is unlimited. Similarly, if you're buying a put, your loss is limited to the premium paid, but your profit is unlimited. So we learned about long call and long put. Our next strategy is covered call. Let's say you are mildly bullish about a stock. You're damn sure that the stock has made a base, and from this point on the stock will not fall. But you're not really sure how much upside is left in the stock. In that case, you will buy the stock. But to make most out of this situation and boost your profit, you can sell call options of safe quantity. What will this situation create? You are buying stock and at the same time you are selling call. It does look like you are creating a neutral strategy. Not even a neutral strategy. In fact, it looks like it's madness. If you are buying a stock, you are anticipating upside moment. So why would anyone go ahead and sell call? The situation why anyone would do this is, you buy a stock because you're damn sure that the stock will not fall from this point on. And you sell a call because you think there is a psychological resistance level that this stock will not clear out quickly. So your stock will basically have a trading range. And in order to take advantage of the trading range, you set up this trap. You buy underlying stock and you sell call. If market was to trade within that trading range, your underlying stock will have either mild profits or no profits at all. But if short call, the call that you have shorted out of the money above the market price will lose its value. The theta will come into effect and it will lose its time value, and that time will be value you will gain, because since you have sold the call, you will gain that time value in profits. So even if your stock price remains unchanged, you will make some profits from short calls. Hence, covered call strategy could be implemented. Worst case scenario: if prices were to move sharply in any direction, you will lose the advantage. This strategy of covered call is basically when market is in trading in a range. If market was to explode in any direction, whether it be in favor of your trade or whether the direction be unfavorable, you will lose the advantage. Because if price was to move up sharply, the gain you made from bought stock will be set off against the loss you will incur from the short call position. Remember, a short call position has a risk profile of limited profit and unlimited loss. The risk profile I showed you about long call, where you have unlimited profit and limited loss. When you sell the same call, the risk profile gets exactly opposite, or the risk profile gets inverted. Here you have limited profit but unlimited loss. So if price was to move up sharply beyond the strike price where you have shorted the calls, the profit made on your stock will be equal to the loss incurred on your call option beyond that strike price. As a result, you will have limited gain. But if prices were to fall down sharply, you will suffer 100% loss on your stock value, but the profit you will gain a little profit from your shorted calls, since your calls will be far out of the money, and if you are to hold a position till expiry, the call will expire worthless. So you could keep a bit of profit from your call options, but you will face 100% loss on your stock position. As a result, it will minimize the loss to some extent, but still loss is unlimited. So the risk profile of this strategy becomes limited profit, unlimited loss scenario. Following is the chart that will tell you how covered call acts like. This line in center is the strike price where you have your call option set or sold off, and this cross line, dotted blurred line, is the stock value. Now if stock value was to stay in this range from this point till here, you will make profit from your sold or covered calls. If stock price was to trade beyond this premium value, then your profit gets blocked out. You can see the black line here. Your profit gets blocked out and you will make no profit, no loss if stock price was to explode to the upside. But if stock price was to fall downside, you will have you will always have advantage of your premium value. You can see here, even though stock price is falling down, the overall price of your position will be a bit higher, this black line. But no matter how high it is, if prices were to continue fall down, you will have to bear losses, even though your losses will be a bit lesser than actual contract value loss. As you can see, the price of the loss value marked in black is a bit higher, but nonetheless it has an unlimited loss risk profile, whereas it has a limited profit risk profile. So if your stock value was to stay in this price range till maturity, you could keep profit from selling the premiums, and whatever your stock value be adjusted with the profit from the premiums will be your profit. So that was about covered calls. The same situation can be, the same setup can be used to exploit a bearish situation. In this case, you will simply create a covered put. Alright, since you cannot sell a stock, you can only set up a covered put in if you were dealing in futures market, because futures contracts can be sold. So your covered put will be something like you have sold your future contract at a certain price value, and you sell a put option anticipating that the level where you have sold your put option will act as a support zone and prices will not break below that support zone. So you can use same covered call strategy for a bearish market as well with puts, but for that you'll have to deal in the futures market since stocks cannot be shorted. Our next strategy is a merit put. In this case, you have a good size position. Let's imagine you have a good size position in a particular stock. You're long term bullish about it. But in short term, due to some news development, you're afraid that stock price might react badly. So you must protect yourself against such short term reactions or corrections. In order to protect yourself from any bearish move, you will simply buy an equivalent number of put options. So let's say you have bought 1000 stocks of a particular stock, and the stock has done well in previous several months. But now due to some internal news development, you think a kind of particular board meeting might have bad reaction on the stock, and the stock might have severe correction. So how do you protect yourself from such correction? It's quite simple. You will simply do a put and a fairly out of the money put. In order to protect yourself from any bearish move, you simply buy an equivalent number of put options. It's that simple. So in case tomorrow morning market was to react badly, your put position would protect your position against any large loss. Once market price crossed the put position, you'd start making profit. So merit put acts as an insurance. Just the way you pay a premium to get yourself insured, and if something was to go wrong, insurance will pay for the losses. Same is the case with a merit put. You'll have to pay, since you're buying the put, you'll have to pay the time value. You'll have to pay a particular level of rent every day to buy that put, to hold the put position. But if something was to go wrong, if market was to react badly, your put position will start showing profits, and that profit will help set off the losses that you suffer on the stock. The same strategy or the same idea could be used for a short position as well. Let's say you have a short futures position in a particular market, and you think that prices might react and prices might rise quickly than anticipated, and all your profits might fade away. So in order to protect your profits, what you will do, you will simply buy a fairly out of the money call value. Let's say you don't want to lose beyond a particular level, so you buy call of that particular level, and you need to make sure that the number of call contracts equals your position, the position you hold. So if tomorrow morning market was to react to some good news and prices were to explode, your short position will definitely make losses, but that losses will be set off by the profits made in your bought call position. So you will not have to worry more about protecting your losses. So options can be used in a multiple ways to help create a position that helps you stay in market longer and stay in your comfort zone longer. Following is the simple chart of merit put. This is how merit put looks like. The red line indicates loss zone. The blue line is where your contracts will break even, your position will break even, your position will have a no profit, no loss scenario, and the green line shows your profit potential. So even though your upside continues to stay unlimited, all you can lose is the premium value of your bought put. But if market was to fall suddenly or drop suddenly to downside, so not this way, but this way, if market was to fall towards zero, you will suffer loss to certain extent, but after that your loss will get limited to that point. Beyond that, you will not suffer any kind of loss. So merit put will help you keep your profits intact. Bull call spread. Let's say you think a stock will go through a mild bull trend. There is a strong resistance point which the stock will not break. So your understanding is that this particular stock will rise higher, but there is a point, there is an upper ceiling which you think will not be broken so easily. In that case, what you can do is to buy a call option that is near the underlying price. Okay, you can buy a call option that is very near to the underlying price, that is very near to being an in the money call option, and sell a call option that stands at key resistance level. Sell a call option that stands at resistance level, or sell a call option that is far out of the money, that is fairly out of the money. This way, you will be able to take advantage of rise in stock price, and the loss in time value that you will face in bought call will be covered by call that you sold. So how does this strategy works? If there is a rise in underlying price, the call option that you bought, which was closer to the underlying price, will have increase in its value greater than the call option that is fairly out of the money, which you sold. So the call option that is nearer to the strike price, nearer to the underlying price, will increase in its value more than the call option that is farther from the underlying price. That is first advantage. The second advantage is the call option you bought will definitely have theta, and since you are the buyer, the theta will act negatively in your favor. So how do you tackle theta? In order to help you to minimize your cost of buying that call, you have sold the call that is fairly out of the money. So since you are the seller of call of that strike price, the theta will act in your favor, and you will get rent to sell that call. So your bought call will generate expenses, your sold call will generate income. When expenses and income are written off, adjusted, you will have lesser expense to bear, and that lesser expense will be adjusted by rise in stock value. So if stock value was to rise, your that little expense will also be covered, and you will be left with a residue profit. Little profit or lesser profit, but nonetheless you will be left with a profit. So bull call spread is basically a strategy that is designed to minimize your losses, keep your expenses less, and still take advantage of a rise in underlying stock value. Now this strategy requires to trade two call options of the same strike and same expiry month, same stock. They have to be of different strike but of the same stock and same expiry month. So it is a strategy to take advantage of moderate rise in stock. It has limited profit potential and limited loss potential. For example, if stock was to experience a sharp bullish move, then the profit you make in bought call will be set off by the loss you will make in short call position that was taken at a higher position. Now remember, a bought call has unlimited profit and limited loss scenario, whereas a sold call has unlimited loss and limited profit scenario. So when market price goes beyond the call strike price, the higher call where you have sold that call, that call will start producing losses, whereas the profit from the call that you have bought will max out. So beyond that strike price, any profit will be written off against the loss made from the call. So beyond that strike price, you will have a no profit, no loss scenario. Similar is the case if prices were to fall sharply below the strike price where you have bought your calls. The maximum you will lose is the premium value, the differential premium value between call you bought and call you sold. That is the maximum you can lose. Here is a visual example of how this could work. Let's say this is the current price of current strike price. This is the level where you have bought your calls, and 25 is the level where you have sold your calls, and this is where market is trading currently. If market was to fall till 24, you will make a little profit, you will make little loss. If market was to rise to 25, you will make little profit. If market was to rise beyond 25, if market was to go this way beyond 25, you will your profits will max out and you will make no profit, no loss. You can see a straight line. Similarly, if prices were to fall beyond 24, you will make loss to a certain extent. After that, you will stop making losses. No matter how low the prices fall, your losses will max out and you won't make any more loss. So this setup is a no profit, no loss, limited profit, limited loss setup. Our next option strategy is protective collar. Let's say you have bought a stock that has recently experienced good upside move. In fact, it has experienced a great upside move, which exposes it to sharp corrections. Or you feel that stock has run out of steam and may enter correction before beginning a new upside move. So you want to lock in profit for now and wait to see how things turn out, but you are not yet ready to sell the stock and get out of the position. So you want a strategy to lock in your position, which can definitely be done by buying a put option. But remember, buying a put option acts like insurance where you will have to pay the premium. What if you not even wanted to pay the premium? All you want to do is you want to create a no profit, no loss scenario with no expenses involved. So in order to do so, you'll have to set up a protective collar. In this case, you use a protective collar, and how it is set up. It is set up by buying an out of the money put option and selling an out of the money call option. In this way, your put option will protect you in case of any severe correction. And since you're buying the put option, you'll have to pay the premium. That payment of the premium you will extract from by selling the call option. So when you sell the call option, you get premium. That premium you will pay for buying the put option. In this way, you create a neutral setup. You have a long stock position, you have a long put position, you have a short call position. But the overall nature of the setup has become neutral. So what happens from that point on? If stocks were to react as you had anticipated, if stocks were to fall down sharply, then that sharp fall will the losses incurred on your stock position from that sharp fall will be reciprocated by the profit made on your buy put option. Straddle. A straddle is a great strategy to exploit random price movement, but a seriously explosive price movement in any direction. A straddle is a strategy where a trader buys put option and call option of a stock at same strike price. Why will a trader do it? Let's say a board meeting is underway of a particular company and the meeting is quite crucial for the company. The decisions taken at this board meeting will severely affect its stock pricing. A lot of traders are anticipating fireworks from this board meeting. So a lot of traders are anticipating large substantial price move in any direction. But they are not really sure in what will be the outcome of that meeting. so they are not really sure in what direction the prices will move. This is where straddle comes into picture. A trader buys call and put option of same strike price in anticipation of a large move in any direction. If prices explode upside, the loss on bought put will be limited, but profit on bought call will be unlimited. Similarly, if price breaks bad towards downside, then loss on call option will be limited, but profit on put option will be. But one must bear in mind that this strategy is suitable for short-term trading as you are buyer of the premium. For both options, in long term, premium loss due to degeneration in time value can cause severe losses. So this is a short-term strategy extremely suitable for explosive moves. This is a setup which has limited loss and unlimited profit potential in any direction. But the move has to be quick and explosive in order for you to be able to take advantage of this setup. So let's go over straddle once again. Straddle setup. For a straddle setup, you buy a call and you buy a put of same strike price of same contract. You're buying this setup because you think the underlying stock will experience a large price move in any direction, but you're not sure which. So you buy a call and a put of same strike price of same stock. If there is a large price move on the upside, your put will make losses, but the losses will be minimum. But your call will make profit and the profits will be unlimited. If the prices were to fall down badly, your call will make losses, but the losses will be minimum and your put will make unlimited profit. So this setup has limited loss, unlimited profit scenario. But since you are buyer of the premium, you cannot hold this setup for longer period of time as you will suffer intense losses due to decrease in theta value on both your option call and put. This is the image of how a straddle looks like. This is the image of your long call, the nature of your long call, and this is the nature of your long put. Okay, if you are long put and this is the stock price, so stock price increases on the right side and decreases on the left side. So from this point on, if prices were to rise higher, this is the point of break even. This is where the losses of the put will be equal to the profit made from the calls. Beyond this price, if stock rises higher, you will make unlimited profit. Similarly, if prices were to fall low, this is the point where the losses made on your call will equal the profit made on your put. If prices were to fall beyond this point, you will make unlimited profit from downside move. A next option strategy is long strangle. A long strangle is similar to long straddle, the only difference being call option and put option are bought on different strike price, whereas in a long straddle, call and put options are bought at same strike price. So long strangle is similar to long straddle, the only difference being call option and put option are bought of different strike price, whereas in a straddle, options bought are of same strike price. A long strangle is mostly inexpensive as compared to straddle, even though it carries same risk profile as straddle. So in a straddle, since you're buying call and put option of the same strike price and that strike price is nearer to the underlying stock value, you will have to pay more to hold that position. Whereas in a long strangle, you are buying an out of the money call and you are buying an out of the money put, which has lesser premium as compared to options that are nearer to the stock value. So in this case, you are paying lesser premium to hold the same strategy. Unlimited profit, unlimited loss, unlimited profit and limited loss risk profile. But you are doing this with an out of the money options. Now the disadvantage of this is you will have you will need the prices to make longer moves for this strategy to make generate profit. Whereas in a long straddle, if prices made sharp move, you will need lesser amount of move to reach the point of break even. Whereas in a long strangle, you will need prices larger amount of price move to reach the point of break even. But it has same risk profile. If prices were to move extremely in your direction, you will have the same profile of limited loss and unlimited profit, no matter in which direction prices move, as you're still the buyer of call and put option. The only difference being these options are being bought at different strike prices and they are fairly out of the money. Following is a chart of a long strangle. These are the levels, these are the strike prices where you set your options. If we hold this as a line, as stock value decreases towards left and increases towards right. If stock value, if consider this as center, this is where you buy your put out of them, which will be out of the money put, and this is where you buy your call, which will be out of the money call. If prices were to rise from this point on, this is the place where the profit made on your call will be equal to the losses incurred on your put. Beyond this point, if stock continues to move, you will make profit. Similarly, if prices were to fall down, this is the point where the profit made on your put will equal the loss made on your call, and beyond this point, if prices were to fall, you will make profit. So a long strangle is similar to a long straddle, the only difference being a strangle is cheaper than a straddle, but you will have to have larger price move for a straddle to come into profitability, and you whereas a strangle to come into profitability, you will need a fairly shorter price. So that brings us to sections of complex strategies. Previously, the strategies we learned were simple strategies involving one or at the most two option strike prices, using two options at the most. In these strategies, in complex strategies, we will be using more than two option strike prices and combination of different simple strategies to set up these complex strategies. The next two strategies are complex strategies and will require a deal of understanding and study into their nature before you really get into trading them. This is very important. Even though these complex strategies have great advantage above the traditional strategies, but still you will require a level you will have to give considerable amount of time in understanding these strategies and understanding the nature of how these strategies work before you really get to grasp the nature of these strategies. These strategies use more than two strikes and multiple combination of option position to create an advantageous position and exploit one of the trades. These strategies are butterfly spread and iron condors. Let's get ahead to learn about our first strategy, that is butterfly spread. A butterfly spread is a neutral strategy. Its main aim is to create a profit range where the setup will generate profit over time. A basic butterfly can be set up as follows. First, buy a call at one strike price, sell two calls at higher strike price, buy one more call at even higher strike price. It might sound confusing. So let's imagine you can for a moment close your eyes and imagine what we are really trying to do here. We are buying a call at one strike price, selling two calls at strike price higher, and buying one more call at strike price that is even higher. So if the selling two call strike price was to be taken as center, so what you are basically doing is you are selling two calls at one strike price and then buying a call that is a strike price lower and selling a call that is strike price higher. So the two sell calls at same strike price becomes your body of a butterfly, and the board call above and below that body forms the wing of your butterfly. Hence, it looks like a butterfly when plotted, so the name butterfly. The main idea of doing this is to create a profit range. Let's say your stock is trading in a particular profit range, it is trading in a particular range, and you want to take maximum advantage of that range trading. So in order to take advantage of that range, you set up a butterfly spread. So the sold call in the middle act as the body, whereas two long calls on both sides act as wings. The range for higher strike price to the lower strike price becomes a profit range. Even though this setup is a neutral strategy, placing this setup at different strike price might considerably change its nature. It might very easily turn from neutral setup to a bullish favoring setup or bearish favoring setup. Hence it becomes necessary to carefully understand the nature of setups before implementing them. A butterfly can also be set up using put options at same time. At other times, it can also be set up using a combination of call and put options. So a butterfly setup is used mostly to take advantage of a trading range. When prices are trading into a given range, your sold calls will generate you theta premiums, whereas the bought calls above and below will protect you against any kind of severe price move. This same strategy can also be set up using put options. Let's go ahead and take a visual look of how it looks like. Now this is how the risk profile of butterfly spread looks like. Long butterfly spread. You can see it does look like butterfly with these as wings and this as the body. So if prices, this is your first strike price where you buy a call, bid strike price where you sell two calls, and next strike price where you buy one more call. So if prices were to stay here at mid strike price, this will be an in the money call, this will be an out of the money call, and this will be at the money call. From this point on, if prices continue to trade in this trading range, you will generate profit as time nears expiration. So butterfly spread is basically a spread to take advantage of theta. It will generate profit over time as option strike nears its expiration. As option strike nears its expiration, you will start having profit. If prices were to move beyond your strike price, you can see you will start generating loss, but beyond this strike price, the loss will get set off, max out. The loss will max out, and you won't generate any more loss. Similarly, if prices were to fall from this point, you'll start generating loss till this point, till the strike price you have bought. Beyond that point, your losses will max out and you won't make any more loss. So a butterfly spread is basically a spread to take advantage of decaying theta, and it will generate profit over a period of time. Our next option strategy is iron condor. It is a simple iron condor strategy involves selling an option which is fairly near the strike price but is not in the money, and buying same option of different strike which is out of the money. The idea is to keep high premium that a trader will get by selling near the money option, and he will make profit as long as market continues to stay beyond the option strike price that he has sold. It is a limited profit and limited loss strategy where maximum profit will be net premium received after selling near the money option and buying far out of the money option. Maximum loss will occur if market was to expire at strike price of the option that is bought by the trader. So this option strategy is set up when a trader knows that market is trading at a resistance point. Beyond this, and market will react from here and will not go beyond this point, but is not completely sure. So he sets up an iron condor. He will sell near the money, but still out of the money call or any out of the money option for which is trading at higher premium. He will sell that and keep the premium. At the same time, to protect himself from any kind of sharp move against his favor, he will buy an even higher and even out of the money option. He'll buy it to protect himself from any kind of adverse sharp move. So as long as market continues to stay below his sold strike price, as long his sold strike price continues to stay out of the money, the sold call or the sold option will generate premium, will generate negative theta, which will act as profit for the trader, and the loss from the negative theta of bought option will be lesser as compared to the profit from the option that is sold and which is near the money. So an iron condor helps a trader take advantage of a consolidating or a stock that has found resistance or upper cap. Even if the stock does not falls down, even if the stock continues to stay in a trading range, as long as his short option continues to stay out of the money, the trader will continue to make profit. Following is an image of long call iron condor. This iron condor is set up by taking long calls. So how is this setup created? This is the line of price change of the stock value. The stock value increases towards the right side and decreases towards the left side. These are the strike prices. If price value is set here at this point, you can see these two, both of them will be out of the money call options since they are above the current price value. So the nearest out of the money call option is to be sold, and the far more away from the money call option is to be bought. As long as price continue to stay beyond this strike price, within this strike price, the short calls will generate positive theta and will generate profit. The long calls will generate negative theta and will generate loss, but the profit from short calls will be greater than losses from the long calls, and the trader will have a net profit position. But if market was to go beyond this short call, the trader will start generating loss. You can see the line coming down at this point, at the point where long call at the point of long call, the trader will have a break-even point where his profit will equal the profit from short calls will equal the losses from short calls will equal the profit from long calls. But beyond that point, he will continue to generate losses to this point, and beyond this point, if market was to continue go up, his losses will max out and he will not make any losses anymore. Similarly, the same option strategy can be used towards for in the money call options. All you have to do is short nearer in the money call and go long farther in the money call. If prices were to move till this range, this is the profit range. If prices were to move in this range, he will continue to generate time valued profit. But you can see this is the maximum profit the trader can get from the time value decay. Beyond this point, even if time was to go extend any further, he will not make any more profit. So this is a limited profit and limited loss setup, iron condor, and in this long call condor spread, there are 4 strike prices used
two of them are in the money, and two of them are out of the money strike prices. So a fairly large trading range has been set up to take advantage of the trading range. So that brings us to the end. We learned about different factors affecting option prices: delta, vega, theta, and rho, how these factors determine option prices, and if you know about these factors, how you can take advantage of them, exploit them. And then we learned simple option strategies, followed by a bit complicated, followed by option strategies that used two option strike prices. And then we learned two of the most popular option strategies, that is a butterfly spread and iron condor spread, which uses combination of multiple option strategies, and these spreads can help you understand. These spreads are basically a limited loss to limited profit spread, and they help take advantage of a trading range. So that's it for our current tutorial. Thank you.